on Business Incorporated today. Ethiopia's Ministry of Industry and the United Nations Industrial Development Organization signed a €2 million agreement for integrated agro-industrial parks. The African Development Bank Group approves $47.09 million grant for Mozambique's Special Agro-Industrial Processing Zone. Morocco and China signed Belt and Road Agreement. Welcome to another episode of Business Incorporated on Channels Television. I'm Ini John Mekwa. Well, let's start the show with the market numbers. Now, in Africa, major markets were mostly negative at intraday, as the NSE and GSE were lower by 0.15% and 0.93% each. For the EJX 30, it was unchanged, while Kenya closed positive. It was up almost 1% yesterday. It's a slightly different picture in the Middle East, where markets we track were mostly mixed at intraday. In the UAE, the Abu Dhabi index fell 0.14%, while Dubai's main index dropped almost 1%. Elsewhere in the region, Saudi Arabia's index was marginally higher by 0.10%. For Qatar index, it was up by 0.31%. We move to Europe now, where markets slid at open, down 1.2% following U.S. sell-off yesterday. The Dow Jones Industrial Average declined for the first time this year, 2022. Well, today the market may respond to France, which has reported Europe's biggest ever daily COVID-19 case, over 330,000. Well, we have Rob Watts joining us from Berlin now to tell us how businesses and public services are responding to these numbers and other developments. Hello, Rob. Well, how deep is the impact of Omicron in Europe when we talk about the markets and other developments, especially the businesses?
Well, Omicron is having an enormous impact, and you can just see it in the numbers in Europe. In France, where Omicron is now the dominant variant, there are over 330,000 cases reported on Wednesday. Now, that's by far France's largest daily total, but it's also the largest daily total seen by any European country during the entire pandemic. Omicron is also dominant in the UK as well, and that's also been driving up record numbers of cases there too. It's averaging around 200,000 a day in the UK at the moment. Now, all the evidence seems to indicate that Omicron leads to milder illness than previously dominant variants, and high levels of vaccination mean we're not seeing the surge in hospital cases that was at one point feared anyway. However, a major knock-on effect is the number of workers that it's putting out of action. Key services and businesses are suffering staff shortages, with so many people either sick or just having to isolate. The UK government says around 1 million people are currently in self-isolation, and staff shortages are one of the biggest concerns when it comes to ensuring that health services, for example, aren't overwhelmed.
And 1 million people in isolation, that's a big deal. But what's the government doing to limit the damage from Omicron?
Well, in France, there's a big emphasis on getting even more of the country vaccinated. President Macron has been championing some pretty controversial proposals aimed at making life more difficult for the unvaccinated in the hope of encouraging them to get the jab. Meanwhile, Italy has just approved mandatory COVID-19 vaccinations for the over 50s. One of the measures taken in the UK was to reduce the amount of time people have to isolate for if they do get a positive test result from 10 days down to 7. Now, Germany is also planning something similar, specifically for workers in critical sectors like hospitals and public utilities. Their isolation could be reduced from 14, as it is now, 14 days, to as little as 5 days under proposals being considered by regional leaders. That's for critical workers, but it would be reduced to 7 days for the rest of the population.
Okay, another challenge which Germany is facing is inflation. What's the latest on that?
Well, official figures for inflation in Germany last year are expected to confirm that it is at levels not seen for around 30 years. It's ordinary German citizens, too, who are bearing the brunt of it. Consumer prices were over 5% higher at the end of 2021 than they were at the end of 2020. And inflation has been driven by the resurgence of Germany's economy from the depths of the pandemic. The big contributor has been rising energy costs as the economy recovers. Demand's been returning, but supply hasn't been able to keep up with it. And those supply shortages have also affected the availability of lots of products, driving up their prices too. Plus, Germans have also seen a jump in prices because a temporary reduction in sales tax for the pandemic has now expired. However, inflation here in Germany and in many recovering economies is set to be one of the major issues for central bankers during 2022.
Well, I will certainly have a lot to follow up when it comes to inflation and some other factors, economic factors in the year. Thank you so much, Rob. Enjoy the rest of your day. We move over to the UK now, and it's almost 2 years since Brexit took effect. But I guess it's fair to expect that the UK and Europe will still be adjusting to the rules and guidelines. So now there's a new IT system for transporting goods. Juliana is close to the action and has the details. Hello, Juliana. Good afternoon.
Good afternoon, Innie.
So what's this new Brexit border rules?
Yeah, well, there's a new system that's been put in place, the Good Vehicle Movement System, and already it's only been a few days, but it's causing havoc. According to some reports, some lorries have been stuck at the border for days now because of more red tape, more bureaucracy, more delays at the border. Now, typically, over the past couple of years, the only time we've really seen Brexit restrictions are for goods coming into the UK, but now it's a blanket system. So it's for goods coming in and out of Britain. But the Goods Vehicle Movement System is apparently having some sort of IT infrastructure meltdown. And really, it's a factor of three different issues. The first issue is to fill out a customs declaration form. Of course, there have been so many delays because the system was just up and going. So if you were coming in to Britain or going out of Britain, businesses had 6 months to fill in this form. So essentially, they were able to backdate some of the data. That's no longer the case from the 1st of January. You have to make sure at the border the custom declaration form is filled out. Also as well, the country of origin, that's a huge issue now. So if you don't want to have a hike in tariffs that you're going to pay at the border, you must ensure you've listed exactly where your goods have come from. And another major issue which is causing lengthy delays is an inspection that takes place to make sure that all produce coming in and out of the UK doesn't have any disease. And if this hasn't been filled out properly, or if the system, the goods and vehicle movement system, hasn't captured it properly, then customs officials have to open the lorry and individually check all goods. It's basically causing a lot of havoc. Lots of businesses are complaining. We don't yet have a full statement from the British government, but of course we know that Brexit delays and Brexit issues have been taking place for the past couple of years. It doesn't look like it's going to abate anytime soon. And one of the issues I think businesses are having is what happens further down the line after Christmas. January is generally a very, very quiet month, but once a trade starts to pick up, is this going to have long-lasting effects? Especially because if you look at the latest data from the British Chamber of Commerce, they're already showing that 50% of businesses that export to the EU are having issues with bureaucracy. And according to the Food and Drinks Federation, 30% of businesses in the UK are no longer exporting to Europe because of these issues. So another day, another Brexit issue, Innie.
Yeah, well, if it's not Brexit, it's Omicron, because we have the services growth and it's down to a 10-month low. And some people have connected it to Omicron.
Well, absolutely. The service sector is the all-important piece of private sector data for the economy, because we know that it contributes to about 80%. It has come in at a 10-month low in December, from 58.6 in November to 53.5. Economists are, of course, citing Omicron, because we know that there were mass cancellations, even though there weren't huge restrictions put in place in December. Well, not in all parts of the devolved nation, certainly not in England. Lots of people were following government guidance. They weren't going to Christmas parties. They were reducing the amount of time they were spending money outside, because they wanted to celebrate Christmas with their loved ones. If you happened to be caught up in pingdemic and you were pinged, you were not able to do so. So lots of people were curbing their activities outside, which meant less people were spending. I think there are concerns that we could see more dips in the PMI. Of course, 50 is still showing expansion. Anything below 50 shows contraction. So 53 is still a relatively good number. But with high inflation, and we know that lots of people now are curbing back because businesses are no longer bearing the brunt of inflation, it is starting to trickle down to consumers. Will we start seeing these PMI numbers fall? Lots of anticipation that UK GDP could be the biggest amongst G7 nations this year, but we're not expecting it to be so good in Q1, considering not only is it cold, Innie, but also people are worried about the increase in prices at the moment.
And it's everywhere. I mean, we just talked about it with Rob in Berlin. But what's the market looking like at this time?
Yeah, not great. The start of the year was pretty good. Of course, we had a chop start because Monday was a bank holiday, and yesterday the FTSE did hit above that 7,500 point, that all-important number, but it's fallen below that, mostly because of the minutes that were released by the US Federal Reserve last night, showing that an interest rate rise in the world's largest economy is imminent. Hong Kong fell, and then London fell shortly after. So the FTSE is actually down at intraday, down by 0.40%. That's the all-share. The FTSE 100 is down by 0.31%, and the FTSE 250, that domestic market, that's down by 0.81%. In currencies, the British pound is down on the US dollar by 0.18%, also down on the euro by 0.19%, and down on the Japanese yen by 0.41%. There are some rises, though. The travel-related stocks, they're all rising. IAG, Wizz Air, EasyJet, they're all up because of yesterday. Prime Minister Boris Johnson made the announcement during Prime Minister questions at the House of Commons that from Friday, you no longer need to take a pre-departure test when you arrive into the United Kingdom. You also do not need to isolate until you get a negative result back, and you don't need to take a PCR test, which is more costly. You can take a much cheaper lateral flow test. So that's really buoyed the travel sector. So from Friday, it's going to be much more easy to travel into England at the very least. Also, as well, banks, they've all risen because, of course, if interest rates rise, their profitability rises. So a mixed-matched day on the FTSE in London.
Yeah, well, I guess it's safe to say that the voice of the travel firms have been heard. I know they were talking about it, was it yesterday or so? They were talking, suggesting this.
Absolutely.
Yeah, thank you so much, Juliana. Enjoy the rest of your day.
Thanks, Innie.
So today, shares in Asia Pacific declined following losses overnight that saw the Dow Jones Industrial Average notching its first decline of the year. In Japan, the Nikkei 225 slipped almost 3% to close at 28,487.87, while the Topix Index dipped over 2% to almost 2,000. In Australian stocks also saw heavy losses as the S&P AX 200 fell by almost 3% on the day to over 7,000 points, with shares of Afterpay plunging nearly 11%. Hong Kong's Hang Seng Index shed 0.14% as of its final hour of trading. Hong Kong listed shares of debt-ridden developer China Evergrande Group surged nearly 2%. The Shanghai Composite in mainland China closed 0.25% lower at 3,586, while the Shenzhen Component slipped 0.66%. South Korea's Kospi fell 1.13%, closing at almost 3,000 points. In Southeast Asia, the Straits Times Index outperformed the broader region as it gained around 0.6% in afternoon trade. MCSI's Broadex Index of Asia-Pacific shares outside Japan traded 1.32% lower. In the United States, stock futures seem to be on the path to recovery after trading were muted in early morning trading. Major U.S. stock averages fell sharply in the first losing regular trading session of the year. Futures on the Dow Jones Industrial Average was up 0.24%, while S&P 500 futures was on 0.06% higher. Nasdaq 100 futures was 0.35. Minutes from the Federal Reserve December meeting revealed the central bank discussed reducing its balance sheet in another move to aggressively dial back its pandemic-era easy monetary policy. The first plan to reduce the number of treasuries and mortgage-backed securities it holds comes as its bond purchases and is set to hike interest rates after the taper concludes. Now, for some months now, we've been discussing high energy costs in Europe, Asia, and other parts of the globe. Global coal prices sent into a flurry last year, 2021, after Indonesia, the world's largest exporter of thermal coal, announced plans to institute a total ban on its coal exports from this month to satiate its own domestic energy demand and prevent outages at its generators. Well, let's talk about what this would mean for the world and Nigeria. We have Longji Dafoe, analyst with Financial Derivatives Company. Hello, Longji. Good afternoon.
Good afternoon. Thank you for having me.
So what impact do you think this Indonesia's coal export ban would do to the global economy and, of course, to Nigeria?
Yeah, so like you rightfully said, Indonesia is the world's largest exporter of thermal coal. To put some context to this, Indonesian trade exports receive about $3 billion per month from coal exports alone. And Asian powerhouses, Asian economic powers such as India, China, South Korea, and Japan accounted for a total of 73% of Indonesian coal exports last year. So it's suffice to say that these Asian economic powers have now found themselves in sort of a sticky situation, given the fact that Indonesia has decided to ban these coals since they are so heavily reliant on it. So as to how exactly this will affect the global economy and so on, Asia, China specifically, is the world's largest manufacturing output producer. So about 30% of manufacturing output last year in the world came from China alone. And about $2.6 trillion was the value of China's total exports last year. So what we are more than likely to see is as energy costs rise, we're more than likely going to see manufacturing costs rise for these manufacturers as well, which is going to trickle down into the prices of the manufacturing goods they make, which will of course trickle down into the prices of the goods that get exported globally. Amidst the rising inflation that the world is currently going through, this is a very big problem. It's more than likely going to exacerbate global inflation concerns, which are already at an all-time high. First, central banks around the world are also more than likely going to need to have either already instituted interest rate hikes or are pondering instituting more interest rate hikes. So this is definitely going to, shall I say, boost those concerns. Now, in regards to Nigeria specifically, China is Nigeria's largest import market. So Nigeria imports most of the goods it gets from China. So rising costs in China are more than likely going to lead to imported inflation into Nigeria. So this is, like you said, not a very good situation for Nigeria.
Yeah, well, signals to one of the things that the World Bank said that Nigeria's inflation should be really looked at this year. Well, coming off the backdrop of last year's COP 2016 climate summit and amidst the recent global push towards environmental sustainability, would you say that Nigeria has attained the stage of shifting away from brown energy?
So short answer to that question is no. The long answer is, as we all know, Nigeria is highly dependent on brown energy sources, both for revenue and for economic activity. In terms of economic activity, about 86% of electricity generated in Nigeria comes from brown energy sources, so fossil fuels and gases and so on. So it's fair to say we are not at the point where we're capable of shifting or making a shift that quickly. Now, in terms of revenue, 80 to 90% of export earnings which the country makes in total come from oil. 40% of government revenue comes from oil. So, and amidst the, we've also seen sort of a push towards more renewable energy sources globally. So this is more than likely going to affect Nigeria's oil revenues. We know that there's actually been projections that electric vehicles are going to dominate 50% of total car sales in Europe by 2030. There's also countries like Norway present electric vehicles already dominating as much as 65% of total car sales. So this is not good for oil-dependent nations such as Nigeria, at least in the long term. Short term, we've seen oil prices continue to rise and more than likely projected to rise for the short foreseeable future. But in the long term, no, things are not looking too good, and Nigeria needs to wake up and do some work.
So how do you see all of this impacting the government's plan to revive the Ajaokuta steel mill?
Yeah, in a word, I'd say it is rather counterintuitive, given the fact that Nigeria at COP26 made a pledge to curb deforestation in the country by 2030. And by 2060, it also pledged to reduce net carbon emissions in the country to zero. Now, steel production accounts for about 3 million tons of carbon emissions a year. More context is that, to add more context, sorry, 1.8 tons of carbon emissions come from every single ton of steel produced. So going about the Ajaokuta steel mill while trying to institute climate change initiatives and so on is rather counterintuitive. The government has actually decided to institute some certain things, such as the climate change bill, which the president signed into law in November of last year, and also certain NGOs and organizations which have popped up across the country aimed at trying to curb the issue of climate change across Nigeria, which Nigeria is currently dealing. So another thing which is of note is that the Ajaokuta steel mill has actually been unproductive for about 30 years, with about $20 billion 20 billion naira or so spent on its maintenance over the last 6 years, despite its unproductiveness.
All right, Longjeetha, thank you so much. I can see you have a whole lot of information, but this is an ongoing conversation where we talk about clean energy and balancing it with the needs in different economies. Nigeria being our focus at this time. Thank you so much, Longji, and enjoy the rest of your day. So moving on now, Morocco and China have signed an agreement sealing a strategic partnership between the two nations as part of Beijing's Belt and Road Initiative. The partnership is aimed at facilitating cooperation in infrastructure, trade, investment, industry, agriculture, and more. And in Algeria, the state-owned oil and gas group Sonatrach will invest $40 billion in oil exploration, production, and refining, as well as in gas exploration and extraction between 2022 and 2026. According to the management, $8 billion will be invested in 2022, and 1/3 of these investments will involve foreign partners. Moving on to Uganda now, a government has withdrawn the mandatory COVID-19 vaccination for all passengers using public transport. The cancellation of the directive comes barely a week after it was announced by the president as a condition for reopening the economy and allowing public service vehicles to load to their full passenger capacity. And in Mozambique, the board of directors of the African Development Bank Group has approved $47.07 million grant for the first phase of Mozambique's special agro-industrial processing zone. The grant from the African Development Fund will help improve agricultural productivity and agribusiness development in the Niassa province, advancing institutional capacity, skills, and entrepreneurship to spur agricultural value chain growth. And Ethiopia's Ministry of Industry and the United Nations Industrial Development Organization, UNIDO, have signed a €2 million agreement to support integrated agro-industrial parks funded by Italian Agency for Development and Cooperation. This agreement will contribute to the development of agro-industrial sector and the creation of decent jobs and economic opportunities in the rural areas of Ethiopia. That's the program for today. Thank you so much for being a part of it. I'm Ini John Mekwa.